Meanwhile, time now for Options Insight. We're getting just about 40 minutes to that closing bell. Let's take a look at the equity and bond sell-off with who else? Our own Taylor Riggs.
We're going to try to do this in a non-fungible way. That is Options Insight today. And helping me do this is Al Nuckman, the Chief Market Strategist at St. Paul Research. Alan, we just have to start with the sell-off that we're seeing today. Sell-off in equities, sell-off in bonds, and yet the VIX only about 2 or 3 points higher, and you're below that 30 handle. What cues are you taking from the VIX right now?
Exactly. You just laid it out. This is a profit-taking pullback until proven otherwise. We had an epic earnings season and a lot of positive surprises, and you're seeing the markets take a little break. All we've done so far is essentially given back Monday's gain and a little bit more, but you've got to remain positive and optimistic. If you look, oil prices today as a barometer of the overall economy, new highs there, and that's gone from 0 to obviously 65. So there are positives, and you've got to take advantage of these pullbacks until things change. And I don't think with all this action we keep talking about in interest rates, that's a whole segment, I don't think anything's changed dramatically. We still have ridiculously low interest rates, 1.5%. That's where we stand in the 10-year yield.
Except that 1.55 is translating to Apple that's off 15%, and the NASDAQ that's nearing a 20% drop from its latest peak. How then are you thinking about revaluations and a 10-year that actually might matter?
Well, the 10-year does matter in the fact that people use it for money flow, all right? Are you going to put your money in the 10-year to get 1.5%, or are you going to get the S&P yield, which is double that? Now, let's look at things historically before I get into Apple, which is a good barometer and a great, I think, reward-to-risk target. But if we look at the 10-year note, we went from 0.5% to 1.5% in about a year, and that was after a drop from 3% down to 0.5%. No one was as concerned about the drop as they are this upward movement. We're still ridiculously low. The midpoint of the last 10 years is still 2%, and we're not even to the midpoint. And the midpoint over the last 40 years is 7.5%. We have to raise rates every quarter for the next 6 years to get to 7.5%.
Can you talk to me about your trade?
Sure. At&T, it's risk-reward play. It's a stock that's fallen out of favor, so it's not only buying low, but it's also buying low volatility, looking for something to spark there. At&T is down 20% versus the market up 20% in the last year, so it's some good value. And it's held a range between 26 and 32. It's above the midpoint of that range now, so a break above 32 sends it to 38. And this is a stock that was at 40 or so not so long ago in 2018. So there's a lot of potential there. And the way I'm looking to play is my boring, straightforward stock substitution strategy, where I'm buying the in-the-money call. I'm buying a 25 call. Now, we haven't been to 25 since 2010. A long 25 call, and it's trading for about $4.25, and it's $4 in the money, so the break-even's 25 cents higher. It's going to give a good payoff on just a modest move in the stock, and it's got plenty of time for development.
Never boring with Al Nuckman of Options Insight. Thank you, as always, for joining us today. Markets are next. This is Bloomberg.